Welcome to RBC's Markets in Motion podcast, recorded June 3rd, 2024. I'm Lori Calvasina, Head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this recording for important disclaimers. Today in the podcast, two big things you need to know. First, we highlight how and why old leadership in the U.S. equity market has returned with a vengeance, and run through our latest thoughts on what might get the rotation trade going again. Second, several of the gauges of investor sentiment and equity market risk that we track are keeping us neutral on stocks through year-end for now, and tactically cautious. If you'd like to hear more, here's another 5 minutes. While you're waiting, a quick reminder that if you found this podcast and our research in general helpful, we'd appreciate your support in this year's All-America Research Survey. Voting is open now and lasts through the end of the month. We hate asking for favors, but for better or worse, many people in the industry look at these rankings to gauge who's good and who's not. We think we've done a better job than most of our peers on the sell side this past year and have earned the votes. If you agree, we hope you'll list us on your ballot. Now the details. Takeaway number 1. Old leadership has returned with a vengeance. Whatever bucket of old, safe, secular leadership one picks, it's bounced back with a vengeance. Growth has hit new highs relative to value within the Russell 1000. The top 5 and top 10 names in the S&P have hit new highs relative to the rest of the index in terms of performance and market cap concentration as well. There are a few reasons for this sudden stall in the rotation trade. First, the shift has occurred alongside a move up in 10-year yields and fading optimism around cuts. Second, earnings dynamics have shifted. After briefly favoring value and the broader S&P 500 for much of the 1Q reporting season, the rate of upward revisions to sell-side EPS estimates shifted back in favor of growth companies and the top 10 names in the S&P 500 over the past few weeks. This is similar to what we saw throughout most of 2023 when growth names and top 10 names dominated on this metric. Looking at earnings dynamics a slightly different way, it's worth noting that while the earnings growth advantage of the Mag 7 is still expected by consensus forecasts to shrink relative to the rest of the S&P in 2024 and 2025, estimates of what that shrinkage will look like in 2024 have moved a bit back in the Mag 7's favor in recent weeks. And a third reason for the stall in the rotation trade is that strong economic tailwinds that breathed life into it earlier this year have actually weakened a bit. Quantitatively, we are no longer seeing big improvements to 2024 U.S. GDP forecasts. Current consensus forecasts for real U.S. GDP in 2024 have stalled around 2.4% or slightly below average. Typically, when GDP growth is running cool or below average, growth and large cap tend to outperform. It's when GDP makes a move above average that we tend to see relative strength and value in small caps emerge. Consensus economic forecasts also have real GDP on a year-over-year pace, slowing from around 3% to low 2%, sub 2% levels in coming quarters. And qualitatively, the past few weeks of earnings have dampened economic enthusiasm, with comments from companies suggesting that inflation has started to impact consumer behavior in a more meaningful way. While some consumer companies are starting to discuss price cuts, which is good for the inflation and Fed narrative, we've also been struck by indications from some companies, including one that previously seemed somewhat immune from the economic cycle, that corporate customers are delaying decisions and in some cases struggling to even make them. So what's needed for the rotation trade to get going again? Valuations are already favorable for the broader market ex the top 10 S&P 500 names, so the driver has to be something else. Our work suggests that the 10-year yield needs to stop rising, the market needs more clarity and certainty around the path of monetary policy and the timing of cuts, earnings trends need to improve for the broader market such that they look better than the biggest growth names, and economic excitement needs to start building again. The trigger for a renewal of the rotation trade may also come from positioning. CFTC data suggests that the large cap growth trade, as expressed through NASDAQ futures positioning, is no longer frothy. But it also doesn't look washed out, suggesting overbought conditions could return rather quickly. Hopefully, the transition to new leadership in the II survey this year for portfolio strategy will be a little easier to come by than the transition to new leadership in the stock market. Moving on to takeaway number 2. Several of the gauges of investor sentiment and equity market risk that we track are keeping us neutral on stocks through year-end for now at least. While our AAII sentiment indicator still hasn't technically hit overbought levels, CFTC positioning on the buy side in U.S. equity futures did move up and is close to all-time highs again. Both are keeping us in the neutral camp on U.S. equities for now when we think about where the S&P 500 will be at the end of the year. Separately, equity put call and TDEX, a gauge of tail risk, both moved up last week. The shift off extreme lows adds to our near-term equity market concerns. And one final quick thought on the U.S. election. It remains to be seen how recent political developments will impact it. For now, we continue to see the election as contributing to the fog that clouds the U.S. equity market outlook. We'll be keeping a close eye on the polls in coming weeks. Interestingly, the Trump-Biden spread in betting markets has gotten close to its February 2024 highs, which occurred shortly after a peak in the U.S.-Europe equity performance trade for the year. That's all for now. Thanks for listening, and don't forget to vote. NII, that is.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.